22, question number 1. And of course, we're giving you this free of charge class from RCM College. It's advanced financial reporting. So the question is August 2022, question number 1. So, and you shall always start by reading the requirement. What does this examiner want us to do? So determine the non-controlling interest in S Limited as at 30th June 2022. And then B, consolidated statement of financial position as at 30th June 2022, like that. Great. So then I shall be able to read the question itself. We are told P Limited is a public limited company, has held a controlling interest in S Limited, another public limited company, for 1 whole decade, 10 years. P Limited also has a significant influence over A Limited, a public limited company. All the companies operating in the manufacturing sector, they draft statements of financial position of P Limited and S Limited as at that date were as follows. So go to additional information. They are telling us there, on 1st January 2012, P Limited acquired 60% of the ordinary shares of S Limited for a cash consideration of shillings 10 million, 10,000, talk of 10,000. At acquisition, the fair value of NCI was 6,500. P Limited wishes to use the fair value method of accounting for goodwill. On 1st July 2012, the fair value of the identifiable, that's January, on 1st January 2012. On 1st January 2012, the fair value of identifiable net assets in S Limited was 14,000, and the retained earnings of S Limited were 1,200. The excess in fair value was due to non-depreciable land. Note 2, on 1st January 2022, P Limited acquired a further 20% interest in S Limited for a cash consideration of 3,000. Then the other note that I would want us to read for me to be able to do a group structure is note number 5. I would want to read note number 5 for me to do group structure. We are told on 1st July 2015, P Limited acquired 30% of 1,000 million ordinary shares of shillings 1,000 of shillings 10 each in A Limited, when the retained earnings of A Limited stood at that amount. So, ladies and gentlemen, if you get this kind of a question, of course, the very first thing that you need to do here is to draw for us the group structure. I would want to give you exactly 1 minute to see whether there is a ninja that will be able to draw group structure here. I love group consolidation. I love group consolidation because that is normally the easiest question in AFR. I always start with it, especially if I'm good in terms of time management. Through practice, we have practiced quite a lot. And then I realized that in 40 minutes, I can do like maximum. Group consolidation is the very best that I should always begin with. So I'm giving you 2 minutes. You do for me the group structure. Let's see. So remember here, the parent company is P. It has a subsidiary and it has an associate. Let's see how you put this down. So, ladies and gentlemen, this is what I have here. So I have a company known as who? A company known as P, which has a subsidiary here known as S. And this P has also acquired an associate known as A. So what have they told us about S? Look at S. So we are told on 1st January, note number 1, I'm reading note 1. on 1st January 2012, P Limited acquired 60% of the ordinary shares of S Limited. So we have here 1st January 2012. So 1st January 2012, we acquired 60% of what year of S. It did not stop there. We still went ahead to do other things. Look at note number 2. Note number 2, additional information note 2. On 1st January 2022, P Limited acquired a further 20% in S. So we have here the date is 1st January 2022. So we have here 1st January 2022, we acquired a further 20%. So giving us what percentage here in total? 80%. 80%. So in this case here, remember, this is quite a very, very interesting one. You know, it wasn't an associate and then I changed to a subsidiary status. No, this was a subsidiary from the very beginning. On the 1st of January 2012, we had acquired a controlling stake. 60% is more than 50%. So already we have more than actually a controlling stake from the very beginning. And then in this case here, we came and acquired a further 20%. So basically the change here is what we call control to control. Control to control. When I move from associate, for example, associate to subsidiary, we talk of no control to controlling stake. Like the one that we were doing in our last class. No control. Remember, associate, you don't control it. You simply have what we call significant influence, but you don't control it. But now look at this one here. We are moving from 60% to 80%. 60% is control. 80% is control. So we are still within the controlling zone. It is control, still to control. So first of all, let's agree whether we are together there, this concept of moving from 60% to 80%. Is there somebody who is saying we are moving still, or rather we are moving from control to control? Is there somebody who is seeing that 60% is control, 80% is control, control to control? Is there somebody who is able to see that concept really? Yes, that's very, very important. Very, very important. Very, very important. Then we go to note number 5. On 1st July 2015, P Limited acquired 30% of 1,000 million ordinary shares of 10 each. So basically we acquired 30%. Nothing changed in between. So in this case here, P acquired 30% of A. So I don't even have to really calculate the period there because A is an associate. So this A is an associate. S is a subsidiary. S is a subsidiary. S is a subsidiary. Ladies and gentlemen, once I've drawn the group structure, who can advise us? Once you've drawn this group structure like this, what should be the next thing that you should do? What should be the next thing that you should do? Once I've drawn this group structure, what should be the next thing for us to do? Somebody talk to me this afternoon. What do you think will be the next thing for me to do? Just look at the questions that you have there. Then advise accordingly. What do you think will be the very best thing for us to do? We do the pro forma, yes. We do the pro forma. Thank you very much, Jane. But you see, we don't have P and L. Or do we? We don't have P and L here. So we shall do the pro forma statement of financial position. The pro forma statement of financial position is what we shall do. Thank you so much. So the pro forma is what we are doing here. So pro forma basically means that you come and take parent plus subsidiary. You take parent plus subsidiary, don't add associate. You only take parent plus subsidiary. You take parent plus subsidiary. Great. Parent. So in this case here, the pro forma, we are taking the parent plus the subsidiaries in accordance to IFRS 10, which tells us consolidate parents and their subsidiaries. Don't consolidate parents and associates, no, parents and subsidiaries. So then the name, this is called P group. It is called P group. P group. Consolidated statement of financial position as at which date here, as at which date. Please look at the financial statements provided. They are dated there. Please, my good students, we have to pass. And for us to pass, we need to master this topic, group consolidation, and we must master group cash flows. The moment we do that, and then later on, I'll be showing you other important topics, like, for example, we have EPS, we have reconstruction. I mean, there are topics, once you have really mastered, we shall never meet at this level. We shall meet at a serious level, like what we call the business data analytics. So take keen note of this. This is a very special question for you guys. Consolidated statement of financial, you must write this in full, as that. So the financial statements given there, they are dated 30th June 2022. 30th June 2022, underline. So this is a statement of financial position. So we start with assets, and assets we must always begin with non-current assets. Non-current assets. So non-current assets, are you able to see them? So I can see property, plant, and equipment. Property, plant, and equipment is the first. I'm simply copying. I'm not using my calculator anywhere as of now yet. As of now yet. Oh, it's supposed to be okay. It's supposed to be, I'm told here, whichever, I'm told the date is not very good, but we shall overcome. The date is not very good, but we shall overcome. We shall overcome. Okay, so property, plant, and equipment. Property, plant, and equipment. Property, plant, and equipment. Yeah, the question is here, August 2022. Question number 1. Question number 1. Question number 1. All right, so 30th June 2022. June 2022. All right. So in this case here, property, plant, and equipment. Let's consolidate. Let's put these things together. Are you able to see the figures there for the parent and the subsidiary? Are you able to see the figures there for the parent and the subsidiary? So we have here 16,875. 16,875 plus the subsidiary is S there, which is 10,230. 10,230. Remember, it is still a pro forma. It's just a format. I'll not add anything because later on there will be value uplifts. After that, I can see investment in S Limited. I can't handle here investment in my subsidiary. That has to be replaced. Investment in the subsidiaries, I will replace that with what? I'll replace that with what? Here, somebody investment in subsidiary. That's goodwill. Thank you so much, goodwill. And this, I'll do a working later. This, I need a special working later. After that, goodwill, then we have investment in A. A is an associate. That one, I have to put it on the face of the financial statement. So we have the investment in an associate. Investment in associate. These I have to put it, but I will need what we call a working. I'll need what we call a working. Now from there, we have here financial assets at fair value. So we have here financial assets at fair value. This is a free mark. I can even post the final answer here. Financial assets. Financial assets at fair value. At fair value. So you take the one of the parent plus the one of the subsidiary. If there is any associate figure given there, you disregard it. Disregard that. So I can see it is only the parent which has got this 6190. 6190. So 6190, I can actually come and even take this one here to the far end. This is a free mark. I'm telling you, group consolidation has got very many low-hanging marks. Very many low-hanging marks. So 6190, like that. Ladies and gentlemen, after that, we are moving on very well. So then we go to current assets. We go to current assets. And of course, if you're using this approach, you must be quite nice in terms of what you're generous, in terms of spaces you leave. Like now here, I would leave like 2 spaces just in case something crops up when I'm reading the additional information, and leave like 2 spaces for my total and current assets. And then I'll come and write here. Myself, I can't leave because my board is not that big. But I wish my board was as big as your book. So current assets. I underline like that. So current assets, I'm picking, adding parent and subsidiary. So current assets, what do we have there? Current assets, I have inventory. I have inventory. I have inventory. So inventory, I can see the one of the parent. It is 9980. It is 9980 plus the one of the subsidiary. The one of the subsidiary is 6930. 6930. Is there anybody who knows which adjustment will, in most cases, will be done on inventory, just in a way of trying to test the understanding of group consolidation. Now that we are coming to the tail end of it, anybody who can tell me in group consolidation, which working do you think will go into this as an adjustment? Thank you so much. Thank you so much. It is UPS, yes. It is UPS. But don't do it now. Now we are simply putting down a pro forma. We are simply putting down a format. So don't do it now. But I'm so happy to see that you guys are following here. Then we have here trade receivables. So we have here trade receivables under current assets. I'm simply copying. So receivables, I have 9480 plus 6580. 9480 plus 6580. 9480 plus 6580. All right. And then we have cash and cash equivalents. So we have here cash. These are another free mark. These are another free mark. Cash 5490 plus 3815. 38. So these cash and cash equivalents, of course, I will take parent plus subsidiary. Is there anybody who knows what else can bring? What can bring a change into this? Which other working, I mean, should I always think about whenever I'm looking at the consolidated cash figure? Anybody who could be thinking of something in the additional information that can make you, I mean, make some movie, yeah? Make some movie, yeah? For cash. You know, these things are very predictable. They are very predictable. So what cash in transit or cash on transit, I mean, you guys are really, really doing a very good job, yes? So if I'm told that there's some cash in transit, I'll come and add it here. If I'm told, for example, that there is cash in transit of 500, I'll come and, great, great. I wish I had some money today. You guys, I would have given you serious presents here. So then we shall be able to leave like 1 or 2 lines there for total assets. For total assets. We shall be able to leave 1 or 2 lines for total assets, yes. Now, after that, we are not thieves. We must always account for our total assets. How do we finance these total assets? Of course, we finance total assets through 2 sources only, 2 sources. So we have equity stroke what here? Equity stroke liabilities. So financed by, although we don't write the word financed by, but of course we start with equity. Equity, the owners, you know, you start first of all with the owners' funds. Owners' funds. So you come and give us here a working for equity. Not working, but I mean a section for equity. So equity, we start with ordinary share capital. We start with ordinary share capital. We start with ordinary share capital. I mean, some of these things, I mean, I can even start dancing when I'm doing an exam because there are things that are fairly easy. Because ordinary share capital, not unless there is a share exchange between the 2 companies. Like here, there is no share exchange. We are acquiring our investments through cash. We never gave out any of our shares. So then in this case here, the ordinary share capital will not need any working, no adjustment at all. And I know that for ordinary share capital, I'll always pick which company share capital, which company share capital, parent only, parent only, parent only, parent only. So are you able to see? So these I can just take to the very end of that area here, to the very end there. So ordinary share capital, I can see for the parent only is 20,000, 3 mark. 20,000. Then we have, this was a very good examiner. There is share premium, another free mark. I like this examiner. Share premium, another free mark. Share premium over how much? Share premium over how much? Share premium of 4,000, isn't it? Again, it's parent only. Share premium is parent only. Share premium is parent only. So we have here 4,000. 4,000. 4,000. 4, not 40. 4,000. 4,000. All right. From there, what do we have? We have retained earnings. We have retained earnings. Retained earnings. Retained earnings, we need a working. We need a working. We need a working. That only need group retained earnings, you need a working, which you said we shall never do it in an exam. This shall always be a balancing figure, a balancing figure. Great. Is there any other thing that you guys would want us to bring here? Any other thing you'd want us to bring here? Yeah, we have NCI. we have in this case here non-controlling interest. Please write this in full. Non-controlling interest is a form of equity because these guys will not come to do what here? They'll not come to ask for their money. They've invested with us. It's a permanent source of capital. Should they be tired with our company, they can only sell the shares at the secondary market. They can't come back for their money. So it's a permanent source of capital. We put it under equity owners. You know, there are two owners here. We have the parent and then we have non-controlling interest. Now listen, then we have what we call other components of equity. Right there, other components of equity. Other components of equity. Right in full. Other components of equity. Can somebody in this case here make a wild guess? Why do you think am I introducing these other components of equity? Why do you think am I introducing other components of equity? Other components of equity. We have never introduced other components of equity. Let me give you the reason here. I'm introducing other components of equity because of this control to control thing. Initially, I had 60%. And then now I moved to 80%. I moved to 80%. So when I moved to 80%, I bought shares from who? It means that I bought shares from NCI. 𝗔𝘂𝗴𝘂𝗀𝗏 kidogo. Initially, the parent had what here? 60%. Na NCI walikuwa na ngapi? Kama parent wako na 60%, NCI wako na ngapi wewe? NCI wako na ngapi? NCI wako na 40%. This was the initial status. And then, tukakuja sisi kama parent, we bought an extra 20. So we bought an extra 20%. So we moved to 80%. And by doing this, the NCI was squeezed to 20% because of 100%. Because of 100%. So now, ladies and gentlemen, please listen and I'll make this very, very clear. Whenever you procure, because here you have procured shares, you procured the shares from who? From your NCI. NCI used to have 40%. You basically bought 20% from them. Whenever you buy shares from the other party, from the NCI, you could either make a profit or a loss. You could either make a profit or a loss. So the profit or loss that you will make is what will be accounted for under other components of what here? Equity. Other components of equity. If it will be positive, you will leave it as positive profit. If it's a loss, you'll be able to capture it as a what here? As a negative, brackets like that. This will come out clearer when I do this working over the profit or loss that we shall be able to get when we squeeze our NCI. When we squeeze our NCI, we shall be able to give them money and they'll be able to release some value to us. So shall be able to compare the value they release to us vis-a-vis the cost of that particular 20%. So this one here should not trouble you at all. This one here should not trouble you at all. We shall overcome. Once we reach here, we shall overcome. So we have other components of equity. Now after that, then you should be able to straight away. We should be able to go to straight away. So you'll be able to understand, you know, like now what I'm doing there, I'm basically explaining using words. When I go to the working itself, mechanically, you'll be able to understand. Okay. Now, from there, what else are we told there? So we go to non-current liabilities, free marks there. We go to non-current liabilities. So I can see free marks there. So please write there, non-current liabilities, non-current liabilities. Non-current liabilities, we have the 10% loan notes. Right there, 10% loan notes. Right there, 10% loan notes. 10% loan notes. So 10% loan notes, right there, 10% loan notes. Because of the size of my book, I have to, I'll be able to write this later. So now we are looking at the liabilities, of which we start always with non-current. So non-current liabilities, ladies and gentlemen, I have number one here, the loan notes, the debentures. So the loan notes, what do we have there? We have 10,500 plus 3,500. 10,500 plus 3,500. This rarely changes. It can only change when you're told that the subsidiary, for example, gave a loan note to the parent. If you're told, for example, the parent or whichever If there is an interloan, an internal loan between the parent and the subsidiary, that is when we come and deduct here, which is very, very rare. In most cases, this will be it. This will be the final answer. That addition will be the final answer, so that's a free mark. After that, we have the deferred tax. Deferred tax is another free mark. Actually, no adjustment to it at all. No, I've never seen an adjustment here. So deferred tax. So deferred tax is a free mark, 6150, 6150, 6150 plus, 6150 plus. 18. These are kind of as good as just take these plus. These are right, the final answer there. No adjustment. After that, we go to the current liabilities. So write there current liabilities. So we have there current liabilities. Current liabilities. So current liabilities, what do we have there? I can see payables, really payables. So I can see payables. So payables, what figures do we have there? So for payables, we have 5,700 plus 5,700 plus 3,100. 5,700 plus 3,100. Then we have in this case here, current tax is another free mark. Low hanging fruit. Current tax, we have 1645 plus 735. Now let me ask you a question. Look at Roman 2 of this question. Roman 2 of this question, how many marks does it have? How many marks does it have? How many marks does it have? Roman 2. How many marks does it have? 14 marks. So now those 14 marks, how do we mark? We normally take any seven at 2, any 7 ticks at 2, any 7 ticks at 2. And trust you me, so far you have over how many? Like now these financial assets is free mark. We have this inventory I can't miss. This I'll get right. Cash I can't miss. We have those share capital, share premium, those are 2. All right. Even these payables, I mean, like current tax, I can't miss. Deferred tax, I can't miss. So you'll be surprised, even without doing any workings, you can easily get those 14 marks if you follow this pro forma concept. If you follow the pro forma concept. The worst mistake I normally see students doing, they start in this case here pumping down so many workings and then they get confused in between. They don't even now do this totally, and therefore they miss free low-hanging marks, which they would have easily gotten. All right, so thank you very much. And now for us, of course, we must do the workings. We must do the workings because we are here to learn. Now, so we go now slowly. So then I've been able to do the pro forma. So once I finish the pro forma, then what do you think will be the next working here? Once I finish the pro forma, what do you think will be the next working? Net assets. So I would want us to do the net assets of the subsidiary. We do the net assets of the subsidiary, abracadabra. Net assets of the subsidiary. So we're going to do the net assets of the subsidiary. Net assets of the subsidiary. We shall do the net assets of the subsidiary. So let's do here net assets. Basically, this is like the third last working here. I mean, we're almost there. Net assets of the subsidiary at acquisition and at reporting. At acquisition and at reporting. Now, before you PS, if I am the one, I'll first of all do this. Net assets. Because now net assets will help us to understand our subsidiary very well. So now, when we talk of net assets, is there somebody who remembers the components of net assets? Is there anybody who is able to remember the components of net assets? The equity, thank you very much, Marianne. The share capital. So we have here share capital. In this question, we have share premium, isn't it? We have share premium. Then we have retained earnings. And then we have a fair value adjustment. And unfortunately, this fair value adjustment is learned. They have told us in note number 1, the fair value adjustment is an undepreciable asset. The fair value adjustment is an undepreciable asset. Fair value adjustment is an undepreciable asset, which is land. Read note number 1, the very last sentence. So if they tell me the fair value adjustment is regarding land, then I'll not have depreciation of this fair value adjustment. No. So that is it. Unfortunately, here at acquisition, these guys have told us something very nice. What have they told us at acquisition? What they've told us here at acquisition, let's read note number 1. On 1st January 2012, P Limited acquired 60% of the ordinary shares of S Limited for a cash consideration of 10,000. At acquisition, the fair value for non-controlling interest in S Limited was 6,500 million. P Limited wishes to use the fair value method of accounting for goodwill. On that same date, on 1st January 2012, when we acquired the 60%, on 1st January 2012, the fair value of all the identifiable net assets were 14,000. So in this case here, the total here is 14,000 at acquisition. So can you be kind to Mwalimu here and read for me the share capital? What is the share capital of the subsidiary? Not of the parent. Here we are looking at the net assets of the subsidiary. Net assets of the subsidiary. So are you able to see the share capital of the subsidiary? Go to that equity column. So share capital of the subsidiary is 10,000, isn't it? What do you know about share capital? It doesn't dance. So share capital at acquisition will be 10,000. Share capital at reporting will be 10,000. It doesn't dance, doesn't change. It's the same case with share premium. Are you able to see the share premium at acquisition for the subsidiary? Is there somebody who can see that share premium for the subsidiary? How much do we have there? Somebody? 2,400. So share premium here is 2,400. This is 2,400. Thank you very much. How about retained earnings? Retained earnings at reporting. Go to the equity section of your balance sheet. At reporting, how much do we have there? At reporting, how much do we have there? Retained earnings at reporting. 5950, right? 5950. But now there is something that you guys have to be very cautious about. The retained earnings of the subsidiary as at the date when we were acquiring this subsidiary, when we got that 60%. When you got that 60%, are you able to see the retained earnings that prevailed there? Yeah, still note number 1. Note number 1, the fair value, they told us of that, was 14,000, and the retained earnings of the S Limited were 1,200. I mean, today you guys are really so nice to me. 1,200, yes. 1,200. And then now this is a crazily good examiner, because you can see he never gave you the fair value adjustment. He never told you that the land was revalued upwards of, no, he never told you that. So he came here and told us here that the excess in fair value was due to non-depreciable land. The excess. If you add these 3, you will not get them totaling to 14,000. It will be something small. The excess of this, the balancing figure, will be our fair value adjustment. So are you able to give me this balancing figure, 14,000 minus this, minus this, minus this? Please, whenever they don't give you fair value adjustment, and they are telling you that there is some fair value adjustment, they must always give you the total net assets at acquisition. Always the fair value adjustment will be taken to be the balancing figure, So they're giving me a figure of 400. What do you think of this fair value adjustment here? Fair value adjustment, does it change? Fair value adjustment, does it change? Fair value adjustment, does it change? No. So this one here must also be what here? Must also be 400. So ladies and gentlemen, please go ahead and add for me the total net assets at reporting. Total net assets at reporting. Is there somebody in this case here who has that figure of total assets at reporting? 18,750. Sasa hii hauwezi ukakimbilia PAP. Hapa hauwezi ukakimbilia PAP. Sababu ya nini? Because there was a change that happened in between. In between acquisition and at reporting, there is a change. There is a change here. I'll be able to introduce a column of change. So first of all, I'll just leave this question here. But once I've reached here, then, ladies and gentlemen, I'll be able to think about something pretty fast here. I'll be able to think about something pretty fast here. That I can easily get goodwill. Can I get goodwill here? Can I get goodwill? Is there somebody who can help Mwalimu get goodwill? Can I get goodwill at acquisition? So leave alone the PAP first. Go ahead and give me the goodwill. Yes, I can get goodwill. I can get goodwill. Because goodwill, I'm looking at what is it that I paid? Purchase consideration. Purchase consideration of the subsidiary. So in this case here, the parent consideration. So we have here the parent consideration. So is there anybody who is able to tell us in this case here how much the parent paid to acquire 60% first? How much the parent paid to acquire 60% first? To acquire 60%. How much the parent paid to acquire 60%? They are not talking to me. From note number 1, how much the parent paid to acquire, it is 10,000. Thank you very much. It is 10,000. Now, remember when we acquired this 60%, we were not the only people. We had some other ninjas here that held the 40%. So in this case here, give me the consideration paid by the NCI. So NCI is consideration. NCI is consideration. NCI is consideration. NCI is consideration. That is the fair value of NCI at acquisition. Fair value of NCI. Are you able to see somebody? It is given there. It's given there. Still on note number 1. They gave us the fair value on acquisition. Fair value of NCI. They gave us fair value of NCI on acquisition. 6,000 what year? 500. 6,500. So from there, you will only come and less net assets at acquisition. You less net assets at acquisition. Do you know the figure? Do you know the figure here? Net assets at, do you know the figure? Do you know the figure net at? Yes, they're here net assets at 14,000. So you less this, 14,000. So please less this. You'll be able to give me goodwill at acquisition. You'll be able to give me goodwill at acquisition. Sharon is giving me 20. Thank you very much, Maureen. Maureen is a new entrant here. So in this case here, we have 2,500. Then do we have any impairment loss? Is there anybody who can see some impairment loss? Anybody who can see some impairment loss? Have they given us a policy on impairment? So yes. Look at note number 4. Goodwill was tested for impairment immediately after the additional acquisition of interest in S Limited and was considered impaired by 10%. Remember, goodwill only calculate goodwill once. You can't calculate goodwill at 60% and goodwill at 80%, no. Because, you know, goodwill is control. So long as you have over 50%, you have control, so work with that. So simply come here, impairment loss is 10%. 10% of that 2,500. My board is very tiny. 250. 250. My board is very tiny. So then can you kindly give me the goodwill at reporting right there? Goodwill at reporting. Mary Ann is giving me goodwill at reporting is to, please fix it somewhere here. Final figure. Goodwill at reporting is 2250. Goodwill at reporting is 2250. I want to pause there for a minute, and then we get to hear whether students are really following. Have they been able to follow up to here? Always be very honest with me. You should never, ever massage this model. No. Yes, thank you very much. Great. So then we have goodwill, which is 2250, because you have taken the goodwill at acquisition minus any impairment loss. Minus any impairment loss. Now we are at a very good position of doing something to my net assets. Now we are at a very good position, at a vantage position of doing something to my net assets here. Yeah, 𝗔𝘂𝗚𝗢𝗂 is telling me to explain why we don't consider additional what here? Additional, what about purchase consideration for this 20%? Ah, great question. Remember, when you are getting goodwill, what is the procedure? What does the standard tell us about goodwill computation? You compute goodwill at the point of control. And the goodwill at the point of control is when we acquired the 60%. We controlled that investment. So that is our subsidiary. And once in this case, then you are at the point of control, you give us two things. You give us goodwill at acquisition when you acquired the subsidiary. That we found that as 2,500. So we can't bring in any other. When you get, in this case here, other shareholdings later, you can't bring those monies that were paid to acquire like the 20%. No. Goodwill is only computed once when this particular investment becomes our subsidiary. When it becomes your subsidiary, then you calculate what we call goodwill at acquisition. And now that goodwill will be constant like that. It can only change whenever there is impairment, which in this case here we calculated here as 10% of the 2,500. The other 20%, whatever you will see, when of course we go to, now we want to concentrate with this net assets at acquisition when there is a change. When there is a change, and this change is very, very easy, you'll be able to understand it. So remember we had a change. Remember here, we had 60%. Let me just rub this, make it much better. I don't know how you'll be able to squeeze yours. So remember, initially we had 60% here. And then we went ahead to acquire 20% more. So there is a 20% more to give us what here, somebody? 80% in total. Now, even for example, when we are at 80%, what do you think about share capital? Share capital never changes. Share capital will remain the same. So in this case, I would want you to squeeze. I don't know how you squeeze it. You guys are geniuses. You can write using some red pen in between there. 10,000. Because of the change. Share premium will not change. Share premium will not change, 2,400. Fair value adjustment of land, same, 400. But retained earnings will change. I would want somebody to give me the retained earnings at the point when we have 80% share capital. At the point. Very good question there. Ah, very good question. I'm now getting very good questions here. Students have used the investment in S, which is given in the balance sheet of 12,000. Very good. But you see, this investment here came as a result of what? Our initial 10,000 given in the question. Yeah, not one. On 1st January 2012, P Limited acquired 60% of the ordinary shares of S Limited for cash consideration of 10,000. And then the other 2,000 came in note number. Actually, we made you know, at times it's fair valuation. If you look at note 2, there was in this case here some additional amount paid. There was additional amount paid, actually of 3. If you look at this on 1st January 2022, P Limited acquired a further 20% interest in S Limited for a cash consideration of 3,000. So in this case, if you take 10,000 plus 3,000, that gives us 13,000. So our total investment here is supposed to be 13,000. But now remember, this investment is normally revalued. As you can see, the fair value given on the face of the balance sheet there is 12,000. So somewhere we have made a loss. But you see now the very best you're supposed to know. These are the subsequent amounts paid to acquire this other 20% will not feature anywhere in goodwill computation. So in the goodwill computation, we shall take the cost of our initial investment, which was what year? Which was 10,000. To be able to get goodwill at the point where we acquired the subsidiary. So this will become clearer as we move around. So then I would want someone to come and give me the retained earnings of this subsidiary immediately after the change. Is there somebody who can get this? Abracadabra. We shall overcome. We shall overcome. Note number 2. We are told on 1st January 2022, P Limited acquired a further 20% interest in S Limited for a cash consideration of 3,000. S Limited reported a profit for the year ended 30th June 2022 of 500. Please listen. Remember, the very first acquisition was 1st January 2012. This very first acquisition here was 1st January 2012. And then we came and acquired 20% more. We acquired 20% more. When did we acquire this 20% more? We acquired this percent more on 1st January 2022. So 1st January 2022. And we are doing this financial report. We are doing this consolidated financial report at reporting the date. The date at reporting is 30th June 2022. 30th June 2022. So I'm interested in the time difference between here and here. Is there somebody who can give me the number of months here? Number of months between this and this. Number of months between this and this. How many months do we have in between? You'll understand, I'm not afraid at all. Not afraid at all. We have 6 months, isn't it? We have 6 months in between. And you can see our S Limited. Our S Limited made a profit of how much for the whole year? Our S Limited made a profit of how much for the whole year? For the whole year ended year, it made a profit of 500. 500. It made a profit of 500 for the whole year. It made a profit of 500 for the whole year. It made a profit of 500 for the whole year. It made a profit of 500 for the whole year. It made a profit of 500 for the whole year. Please listen. We have in this case here our basket for retained earnings. So remember, we made 500 for the whole year. And then we have at the end of the year, we have some retained earnings here. We have some retained earnings here. So at the end of the year, we had retained earnings in the subsidiary of how much here? Were they 59.50? At the end of the year, retained earnings was 59.50. 59.50. Retained earnings, so we're retaining our earnings here, was 59.50. 59.50. All right. But now remember, we want to get retained earnings as at 1st of January 2022 at the change date. At the change date, of which you have told me from here to the end of the year is how many months? Is 6 months. 6 months. So then can you kindly go ahead and tell me this section from here to here, how much profit do we have here? It will be 6/12 times that 500, which gives me how much here? 250. So this 250 is what was retained here. This 250 is what was thrown inside here. And then I would want to get, in this case here, the retained earnings here, X there. So I'm saying here, ladies and gentlemen, that my X plus 250 should be equal to 59.50. X plus 250 should be equal to 59.50. Then what is the value of X? What is the value of X? Remember that 250 now is what has gone to this retained earnings basket. The 250 is what has gone to the retained earnings basket. So then when you work backwards, you should be able to get the retained earnings as at this date here. As at this date here. Can somebody give me this figure? So in this case, the retained earnings as at this date, we have here 5,700. 5,700. Remember this concept of working with profits we have encountered before, where the examiner, instead of them giving you the exact retained earnings on a certain date, they tell you that the subsidiary made a profit of this much. So you do your own apportionment. You do your own apportionment. But the most important thing is for us to appreciate the fact that by the end of the year, the total retained earnings is 59.50. And then remember, we want something that happened here 6 months ago. So the 500 is for a whole year. So 6 months, for 6 months, the profit will be 250. And you're saying that this X plus this 250 is what should be able to give me the lump sum retained earnings, which is 950. So then make X the subject. Take this 250 to the other side. It means that X will be 5,700. So then can you kindly go ahead and give me these figures on Germany here? Please go ahead and give me this figure. go ahead and give me this figure here. Give me the total net assets at the point of change. At the point of change. It may not make kind of sense, but we'll be able to understand it. I'll move aside, okay. So how much do we have there? At the point of change. $18,500, isn't it? $18,500. So here we are getting 18,000. Now we've reached a very, very important point, a very, very important stage, but I would want you to take a minute, not actually, I mean, 3 minutes break. We take 3 minutes break. When you come back, you should be able to understand this thing better, because this is normally what I told you. This group changes is what we get in our exams. In our exams, you can get either a group change or a foreign subsidiary. Group change or a foreign, in most cases, group change or a foreign subsidiary. So we are taking 3 minutes break. When we come back, then everything will be okay. 3 minutes break, 3 minutes break, 3 minutes break. When you come back, we start from somewhere. Thank you so much. Hey, now 3 minutes are over. Now we should be able to continue. 3 minutes are over. Now we should be able to continue. Now, ladies and gentlemen, I would want you to help Mwalimu here to get the NCI. Roman 1, they want us to do the non-controlling what here? Interests. Non-controlling interests. How do we get these non-controlling interests? Now we are fresh. Now we are fresh. Now we are okay. So non-controlling interests. So we have here non-controlling interest. This is what they wanted us to give them in number 1. But now remember that there is a change. When there is a change from control to control, there is a small difference, but all of us should be able to appreciate it. So then how do we do this? Non-controlling interest at reporting, NCI at reporting. Remember, this is how we call it. NCI at reporting. So NCI at reporting, you will basically give us NCI at acquisition. Give us NCI at acquisition. Are you able to see the NCI at the point when we were acquiring this? NCI at acquisition is how much? NCI at acquisition is how much? Who are these who are not talking to me? Mary Ann is the only lady talking to me. Maureen, thank you. NCI at, it's given in note number 1. It's given in note number 1, and all of us should be able to see it. NCI at acquisition. NCI at acquisition, you can see there it is 6,500. 6,500. Then go ahead and give us share of PAP 1. You know, now we're going to have 2 PAPs. We're going to have, these will be PAP 1. This will be PAP 1. And this other one here will be PAP 2. We're going to be having a post-acquisition profits, 2 of them. Post-acquisition profit before change and the post-acquisition profit after change. So give us post-acquisition profit 1. Post-acquisition profit 1. So the post-acquisition profit 1, the increase there is 18,500. This is 18,500 minus 14,000. That is PAP 1. But now remember, before change, what was the value of NCI before change? Before change, what was the value of NCI before change? Most of them, 40%, yes. Before change, it was 40%. So can you kindly give me this figure here? Share of PAP 1, 40%. Remember, you're talking about NCI. So remember, this PAP 1 is before change. You can write like that. It's before change. So is there somebody who is able to give me this? Anybody who is able to give me this? 1,800. Thank you so much. 1,800. So then can you kindly go and add there? 6,500 plus 1,800. This gives us 8,000 what here? 300. 8,300. So this is the NCI at change point. NCI at the change point. Yeah, at the change point. NCI at the change point. And then, ladies and gentlemen, now things in this case here flipped. NCI was able to lose some percentage. NCI was able to lose some percentage. Are you able to remember change what happened? At change, the parent company bought 20% extra. The parent company went to 80%. But NCI now went down to what? NCI went down to what? NCI went down to what? 20%. So NCI, so remember that this is at exactly 40%. This is at exactly 40%. And after the change, we have 20%. After the change, we have 20%. So please give me the new NCI immediately after change. 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 So remember that this 8,300 was 40%. What about 20%? What about 20%? So here you have to do your cross multiplication. So it will be 20% times 8,300 divided by 40%. Divided by 40%. So new NCI immediately after the change, after their figure has gone down to 20%. So 20%, I'm cross multiplying. I hope you guys are able to see that. 20% times 300 divided by 40%, which will give you what figure? Somebody here? Mary Ann is giving me 4150. Mary Ann has given me a figure of 4150. So please, this is the end of this 8300. 8300, you double underline it. It is the end of it. 8300, you double underline it. You have been able to use it to get this. Now from there, come and add the share of PAP 2. Add the share of PAP 2. Because now PAP 2 is coming after. PAP 2 is coming after the change. Share of PAP 2. So share of PAP 2, I can see it is 18,750 minus 18,500 times what percentage if you're following? If you're trying to follow, times what percentage? If you're trying to follow, times what percentage? Great. Because remember now, PAP 2, now here the parent is at 80%, NCA is at 20%. Thank you so much. 20%. 20%. So are you able to give me this figure? Share of PAP 2 now. Share of PAP 2. Is there somebody who is able to give me this figure? 50, yeah? Yeah, I know that 59 is a typo. So 50. Thank you so much. 50. And then, of course, we had the impairment of goodwill. You remember we had impairment of goodwill. It was full goodwill. When it's full goodwill, then impairment loss must also be absorbed by the NCI. Impairment loss must also be absorbed. So in this case here, come and less a share of impairment loss. Share of impairment loss. So remember, it will be 20%, 20%. What was the total impairment loss? Is there somebody who is able to remember from the goodwill figure? From the goodwill figure, what was the impairment loss? What was the impairment loss? 250. Thank you very much. 250, like that. So 20% times 250, this will give me 50, like that. So meaning that in NCI at reporting will be 4150. So NCI at reporting, NCI at reporting will be that 4150. Please go to your consolidated pro forma. Your consolidated pro forma, where you have NCI, put that figure of 4150. Where you have NCI, put that figure of 4150 there. Where you have NCI, put that figure of 4150. Have you done that? Have you done that? Where we have an equity under the pro forma equity, non-controlling interest. Do you have 4150 there? And then don't forget that this was the first requirement. This was the first requirement where they wanted us to determine the non-controlling interest in S Limited as at 30th June 2022. This figure here. So they wanted us to do this. Anytime they give us a change, control to control, they know that NCI will defeat like 80% of the students. Anytime we have, in this case here, control to control, 60% to 80%, they'll always ask you this NCI. They'll always ask you that NCI. So these are working that I'm really sending you to go and check it out. Check it out. And this question, like now during block release, I normally do this exact question again. For some reason, I always repeat this question for you to even now understand it better. For you to understand it better. So I want to believe that somehow you've seen some small light, a very small light. A very, very small light. If you work on that small light, then you should be able to understand now everything very well about what here this NCI. PAP 1 and the PAP 2 meaning. I mean, PAP is a post-acquisition profit, isn't it? Post-acquisition profit. Remember, like before the change, when we had 40% NCI, that was the first profit of the share. And then, of course, we have now the second profit, which is the share after the change, which will be smaller. That's why we are categorizing them. All right. Thank you very much. Now, after that, ladies and gentlemen, the next working that I would want you to do for me now that we are almost finishing, I would want you to go straight away and give me investment in associate. Investment in associate. This one, I will not talk about anything. This one is your working. Investment in associate. It is normally very easy. Investment in associate. This is normally very, very easy. Investment in associate. This is normally very easy. Investment in associate, I'm giving you 2 minutes. Give me the investment in associate. Give me the investment in associate. Let's see who will be the first one in this case here to put this thing down. Who will be the first one to pin this thing down? To pin this thing down. Investment in associate IS 28 is normally the easiest, is normally the very easiest. It's equity accounting. It's PAP accounting. It is PAP accounting. This is PAP accounting. After 300 changes, 150 right after. I know. This was 150 after. New NCI immediately after the change. You see Pataki here, the old one was 8300. And this old one, what was the percentage of NCI? It's 40%. Now, after the change, what happens? Remember now the parent has taken an extra 20%. Now the parent is at 80%. If the parent is at 80%, then NCI will be at 20%. NCI will be at 20%. So then we are asking ourselves, if 8300 equals 40%, how about 20%? So I came and cross multiplied here. This times this divided by 40. This time divided by 40, which gave us 4150. And then now remember, we come under, after the change, we still went ahead to make profits. So we must share into this post-acquisition profit the second time. All right. And then now there is a share of what here impairment loss that we made there. Thank you very much. There is a ninja that is trying to help Mwalimu explain. There's a ninja trying to help Mwalimu explain. Okay. Thank you, Mwikali. There's a ninja trying to help Mwalimu. Always try to explain to other colleagues. That is very good. That's very good. I hope attacking now with my explanation and with Kali's explanation, you could be a little bit better. So then, is there somebody who has been able to do this investment in this associated company? Investment in the associated company, what amount do you have there? What amount do you have there? Just trial. They're trying. Sylvester is giving me 50, 75. But no. But Sylvester is one of those ninjas that are really, really aggressive. One of those ninjas that are really, really aggressive in my class. Students who are normally aggressive in my classes, I always have. Mary Ann is getting 4400. Mary Ann ameweza kujua group consolidation sana. Mary Ann, I think sababu ya kuuliza maswali na kujibu pia ameweza kuunderstand group consolidation sana. I'm waiting for another ninja to confirm that 4400 or give us their answer. Maureen, great. Is Maureen a new student? I don't seem to remember this great name, Maureen. Are you a new student? Maybe you've attended just a couple of, like, say, 2 or 3 sessions. Are you new or you are an old guard? Oh, Maureen has been around. Then my memory is not very good. Great. Today, for some reasons, gentlemen, today they are not giving me answers. I've noticed that. Gentlemen, today they are not giving me answers. I hope they're not floating too much. You know, in a class setup, you are allowed to float a little bit, but not like totally. Totally ignorant. You should ask questions. Tell them to stop. Okay. So remember, investment in associate is very easy. Investment in associate is very easy. So what do we have here? We have here the cost of the investment in associate. So this associate cost me how much? This associate cost me how much? The associate cost me how much? Mikhail is giving me a different figure there. I love students who give me answers, even if they're wrong. So long as you give me answers, I love. So investment in associate, that is given in note number 5. On 1st July 2015, P Limited acquired 30% of 1,000 million ordinary shares worth 10. So you see, they haven't told me like how much exact amount I paid in the note. So when I'm not given the exact amount paid in the notes there, I should be able to go to the balance sheet. And in the balance sheet, I'll be able to see investment in A Limited is 3650. 3650. Yeah, in the statement of finance, 3650. And then you come and give a share of PAP. Share of PAP. And I've told you, PAP for an associate, you give us the change in retained earnings. EO2, change in retained earnings. For associate is, you don't have to do the net asset for, no. Associate, you only track down the retained earnings. So have they given me the retained earnings? Oh, yes. In note 5, on 1st July 2015, P Limited acquired 30% of 1,000 million ordinary shares of shillings 10 each in A Limited, when the retained earnings of A Limited stood at 1,000. A Limited had no other reserves as at 1st July 2015. As at 30th June, the retained earnings were 3,500. So I can see retained earnings have grown. So 3,500 minus 1,000 times 40%. So utapata ninja hapa amechukua 40%, ama hata amechukua 20%. Unamuuliza kuona yaka 40%, ama anakuambia ni NCI. NCI and associate, do they have a relationship? No relationship. No relationship. So in this case here, the percentage here associated is given clearly there. It is 30% that we acquired. It is 30%. 30%. So in this case here, are you able to give me this figure, ladies and gentlemen? Are you able to give me this figure? Imagine all of you must contribute. All of you must give me figures. All of you must give me figures. So 750. So from there, we ask ourselves whether we had impairment loss of the associate. Not impairment loss of goodwill. Those are different. Goodwill is for subsidiary. Impairment loss of the associate, we are told there wasn't any impairment loss in note number 5. Impairment as at 30th June 20, like that, no impairment loss was deemed necessary. So no impairment loss. No impairment loss. So in this case, you are adding. When you take this plus this, what are we getting, ladies and gentlemen, here as the investment in the associate here at reporting? Investment in associate to be reported. To be reported in the balance sheet. To be reported in the balance sheet. To be reported in the balance sheet. It is 4,400. Sasa kama ungekuwa na kiwaru, ungepigia Mary Ann makofi. Kama unajua mahali kuna makofi kwa Zoom. I mean, ameshajua concept ya associate. Most of us hatukuwa tumejua, lakini uzuri sasa tukipiga makofi as we celebrate her, we shall not forget. We shall not forget. We shall not forget. We shall not forget. Thank you so much. We shall not forget. Thank you so much. We shall not forget. Thank you so much. We shall not forget. All right. Now, ladies and gentlemen, from there, I would want to see whether there is a ninja that will be able to calculate for us and realize profits. Now, before I go to that, can we finish this PPE? Let's finish this PPE. Let's see who will be able to give us the final answer of PPE after they read note 1. Let's see who will be able to give us the final answer of PPE. Who will be able to give us the final answer of PPE? Let's see who will be able to give us the final answer of PPE. Belinda, I love that. Actually, that is the best. Ngota, even. Great. So the Belinda should be able to be the one to give me the correct answer for PPE after you've made the adjustment, the final answer. Let's see who will be able to get this answer. Wa kwanza kabisa. Let me just check here. The final answer, the very correct answer ile ambayo istaki tena kufanya adjustment. The very correct answer ya PPE ni ngapi? Thank you very much, Doreen. Thank you very much, Doreen. We have 𝗓𝗂𝗂𝗂𝗓. I think it's 𝗓𝗂𝗂𝗂𝗓. If I'm not wrong, 10 should be your full name, isn't it? Yeah, all of them are getting this. Because wameniambia mwalimu, we had already done the pro forma. On the pro forma, we had 16 for PPE. On the pro forma, we had 16,875, and then we had in this case here, for the subsidiary 10 to 30, and then there was a fair value adjustment positive of 400. So then the final figure that we have there is 27,505. 27,505. Thank you so much, all of you. Indeed, you are geniuses. Thank you so much. Great. Now there is one. If you get this, I think we should be able to finish the class and we go and do other things like eating lunch. We should eat lunch, right? If we get this correct. So I want a good ninja to give me the correct answer for inventory. Inventory. Remember this one here, 400. We can't depreciate that because we were told that the 400, this fair value adjustment was on a non-depreciable asset, which is land. So no depreciation, no loss in value. Now, what are we working on? It is inventory, the correct figure. For you to do that, there is something you have to compute. For you to do that, there is something you have to compute. For you to do that, there is something you have to compute. For you to be able to get that, there is an abracadabra. There's an abracadabra. There's an abracadabra that you have to do. Thank you so much, Maureen, UPSES. So Kiprotich is getting 16,660. Wow, Jane 16,660. Great. 16,660. Here they are very good ninjas for inventory. They've been able to get the UPS. They've been able to get the UPS very well. Out of curiosity, do we have any student who has not been able to get that 16,660 and they would want Mwalimu to help them? Do we have anybody who would want Mwalimu to do it? To do that working? Great. Okay, fine, I'll do it. Now you see, Joy, I catch you. That's why, Joy, you have not been talking today. Joy, I catch you here, live, Joy. Because Joy said vividly on WhatsApp that she's still on maandamano. She's still on maandamano. All right. I hope Joy kumeza tear gas. We shall overcome. But the Gen Zs, we really treasure whatever you guys are doing outside there. It's very nice. We were not able to do it ourselves. You guys are very good. Like I'm 100% sure, akifinywa tu kidogo namna hii, affordable housing chini. Hii affordable housing ikienda chini, tunaletea zawadi.
affordable na warudishe, ili wamekata karibu mwaka mzima sasa, warudishe because wanafanya affordable housing na hakuna nyumba tunapata. Sasa hamtaki hiyo maneno. Sasa muendelee namna hiyo. But of course you take care wewe. You take care. Great. We shall overcome. I know Vero Chalo anataka nyumba ya serikali. Vero anataka nyumba ya serikali wewe? Unataka nyumba ya serikali? Mimi sitaki nyumba ya serikali. Haitakuja. Iko uongo mingi hapo. Of course we would love your socialism. Socialism is also very good. Lakini haitakuja rahisi. Iko na uongo mingi. Itoke wapi? All right. So UPS, how do we get UPS? It's very easy. You take the profit margin times the remaining intra sales. The remaining intra sales. So here the examiner was very easy. He told us 25% times the remaining intra sales. First of all, what was the intra sale? If you look at this question, the intra sale, the internal sale, the sale that went in between here, the sale that went in between here is how much? If you look at note 3, perimeter sold goods worth 2,000. And then they have told us the expression that at the end of the year, we only had a half of these goods remaining unsold. We only had a half of these goods remaining unsold. So then the UPS figure, itakuja kuwe ngapi UPS figure? Mwikali pia amesema mimi sitaki hiyo nyumba. All right. So then this gives us what UPS figure? 250. Thank you so much. So then we go to the group inventory, the one that you should be able to pick this from your pro forma. The group inventory should be equal to, we had already added a few things there. The group inventory for the parent, it was 9980 plus 6930. 6930. Alafu nasema minus this fake profit of 400. That is how those ninjas were able to get. The 16,660. No. This is 250, so not 400. 250. That's how they were able to get that 16,660 like that. So now I hope, Joy, you are okay now. Yeah, 250. 250. Thank you very much. Joy, now I hope you are okay now that you are fighting for us. You know, there are very many ways of fighting them. You don't have to go to the streets physically. You also fight like through social media. So then, are we together, Joy? Joy, have you been able to see this? It was Joy and someone else there. Are we together regarding this group inventory? Boy, they're not even now talking to me. Thank you so much. Now, you see trade receivables, cash and the cash equivalents, we have payables. I mean, there are no adjustments to be done there. Because like now receivables, there's no inter-owing. There's no internal owing. You're told at the end of the period, no internal owing. So like receivables, is there somebody who can just add for us, give us the final figure? Receivables, we have 9480 plus 6580. Give me the final figure to write on the other side. $16,060, yes. $16,060 receivables. All of us are comfortable with receivables. Cash and cash equivalents, you take 5490 for the parent plus 3815. There's no cash in transit, so you don't need any adjustment in that. 93 what year? 9305. So then is there somebody who can give me the total assets? Add all of them, non-current plus current assets. Is there somebody who can give me the total assets? Remember, already we had the financial assets. We have everything now. Just add all of them. Give me something there called total assets. Give me something there called total assets. Total assets. Everybody has their own answers there. Retained earnings does not come under Wikali. Only one total assets. Retained earnings is an equity component. Only one total assets. Where total assets, we have PPE, we have goodwill, we have investment in A Limited, we have financial asset. Financial asset was 6190. Financial asset was 6190. We have inventory, 16660, trade receivables, 16060, cash and the cash equivalents, 9305. So I'm being told this is correct, 82,370. 82,300. So if you got that 82,370 to be very good to all our comrades, are you able to take a screenshot of your asset section, just asset section, and send, or rather take a photo of that, and send that to our WhatsApp, to our paid WhatsApp there. So our paid WhatsApp, there must be some ninjas who are interested in that format. There must be some ninjas who are interested in that format. There must be some ninjas interested in that format. Once somebody does that, please tell me, done. And today I don't see Mr. Paul around. I'm not seeing Mr. Paul around today. We shall overcome. 82,370. Once you have done that photo and you have sent there, kindly do me a favor. Done. Thank you very much. Thank you very much. Now we go to total, or rather to equity and liabilities. So equity and liabilities, we have ordinary share capital. Ordinary share capital, the final figure, we have written that down. It was 20,000. We have share premium. That's 4,000. We have retained earnings. Retained earnings, we don't like doing it, but for the sake of your, this should be the last time. I know there are students who will tell me, Mwalimu, why don't you do it? But this should be really, really the very last time for us to do retained earnings figure. Should be the last time. We should not be doing it at all. It should be the very last time. So retained earnings, what do we have here? We start with, so group retained earnings. I don't like doing it at all because it's just wasting of time. So group retained earnings. So we have the parents' retained earnings. Are you able to see the parents' retained earnings, you guys? Parents' retained earnings. Parents' retained. Remember this one, you take 100%. The way it is, from the balance sheet. Look at the P, balance sheet of P. Are you able to see the retained earnings? The way it is at reporting. Yeah, we should always take that as balancing figure, but for the sake of learning, and also for the sake of Mwalimu jogging his mind, you know, I have to jog my mind at times here. For the sake of jogging my mind, let me do it. So are you able to see in this case here? So they are giving me a figure of 16,670, yes. 16,670. And then you come and say here, add subsidiaries, post-acquisition profits. So remember we have part 1. I rubbed my figures there. I rubbed my figures. Part 1, we're going to say 18,500. 18,500 minus 18 something. Part 1. Part 1, oh yeah. Part 1, we're going to say 18,500 minus what here, somebody? Part 1. Less 14,000. Thank you very much. Less 14,000. So under part 1, what is the parent share? Under part 1, before the change. What is the parent share under part 1? 60%. Imagine it's only Mary-Ann who is giving. Thank you, Mercy. 60%. 60%. Remember now we're giving retained earnings is for the parent. So the parent now is getting their share. So 60%. So are you able to give me that figure? Is there somebody who is able to give me that figure? Oh, yeah. Anybody who is able to give me this minus this times 60%? What are we getting there? What are we getting there? 2,700. Thank you very much. They're also going to receive something here. Add sub. So we have here part 2. So part 2, if I remember very well, that one there, was it 18? Was it 18,900 and something? I know it is something minus this 18,500. Oh yeah, I don't know why I have them. My board is very small. It should be something minus something here. 18,750, yes. 18,750. Now, after the change, what is the shareholding of the parent? After the change, what is the shareholding of the parent? After the change, at 20%, 𝗔𝘂𝗴𝘂𝗀𝗂𝗓. The parent has now 80%. The parent has 80%. So come here and give me the figure. Give me the figure there. The parent has 80%. Give me the figure there. Give me the figure here. The parent has 80%. The parent has 80%. So 200. 200. 200. So remember, the parent is also going to receive the associates PUP. Associates PUP. The one that you have up there here now change. Was it 750? Was it 750? Was it 750? 200 won't go. Yeah, associate hapo yuko kuna PUP. Kuna PUP kwa working in associate kuna PUP. It was you pick it the way it is. And then now you come and you less here two things. You less two things. You less first of all here, you less share of impairment loss. Share of impairment loss. So impairment loss, it will be 80%. The parent share is 80%. Was the impairment loss 250? I don't know. The impairment loss, I think it was 250. The impairment loss, I think it was 250. The impairment loss, it was 250. The impairment loss, it was 250. So remember, ours is 80%. We're doing this at the end of the year. So 80% of 250 gives me what here? 200. And then we shall less here the UPS. The UPS, since this is not in net assets calculation. It's not in net assets calculation. Why? Because it is, remember here, it is the parent that sold the subsidiary. It is parent that sold the subsidiary. So this one here is what we call downward. Downward does not go to the net assets. Does not go to the net assets. The one that goes to the net assets is when the subsidiary sells to the parent. What we call bottom up or upward. So when this UPS is not in the net assets, then it has to go to the goal of retained earnings. I'll explain this, but first of all, come and give me the group retained earnings. It needs a lot of thinking, really. I would not want to think like this in an exam, and there's no mark to be given for doing that. Actually, it can even lead you to depression because you even get this group retained earnings figure being wrong. It could be wrong. When you try following these things, it could be wrong. So group retained earnings figure is just somebody who could be having this figure. Group retained earnings figure. 19,870. So we have here 19,870. So please take this figure to your balance sheet, to your consolidated statement of financial position. Take this figure to your consolidated statement of financial position and put there 19,870 there. Have you done that? Have you done that? Have you done that? Have you done that? Have we done that? 1970, have we done that? Mariana nataka tuende mbio. Hapana, tuenda mbio hivyo. Have you done that 1970? Have you taken that there, the other side? We shall overcome. We shall overcome. Yes. Yeah. How about NCI? Have you taken NCI to the other side? Have you taken NCI of 4150? Is it 4150? Is there somebody who has taken NCI of 4150 to the other side? Now we can do what Mary-Ann is asking us to do, the OC, other components of what here? Equity. Other components of equity. OCE, other components of equity. Other components of equity. OCE, other components of equity. So these other components of equity happens when there is a change. So calculate when there is a control to control change. A control to control change. So basically, this is the profit or loss. Profit or loss associated with that change itself. Profit or loss associated with that change itself. So then you shall be able to give us the revenue here. The revenue. So the revenue is the amount that we snatched from the NCI. The revenue is the amount. You know, the NCI lost some amount. When they were at 40%, they were at something. NCI, they lost some amount. The amount they lost is what we took this aside. So is there somebody who is able to remember how much in this case here the guys here were able to lose? So remember here, for you to get this revenue, you will take in this case here value of NCI, before change minus value of NCI after change. So if I remember very well, this was 8,300. Before change, it was 8,300. Minus the value of NCI after the change. Was it 4150? I can't remember very well. Was it 4150? Was it 4150? 4150. Hapa najua nimewapoteza woye. Nitarudia tena, don't worry. So revenue is 8,300 minus 41. Listen, you know, this is the value lost by NCI. When they sold at 20%, they lost that value. So we, the parent, gained this value. We're the ones who bought this value. So this is our revenue. This is our benefit. It's our benefit. So somebody, this will give me 4150 like that. So at what cost? What was the cost to us? What was the cost to us? How much do we pay for that 20%? How much do we pay ourselves? 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 We paid 3,000 for that. So we paid 3,000 for that 20%. For that 20%, we paid 3,000 given in note number 2. We paid 3,000. 3,000. So then we made a profit. We made a profit of how much here? There's a gain. Probably call it gain. There's a gain of 150 like that. So this is what goes to our equity. But remember, this equity will be other components of equity. We call it other components of equity. Other components of what here? Equity, OCE. Other components of equity will be 1150. Marianne is asking a question there. You know, these guys, when they began, this NCI, when they began at 6,500. Then they had a PAP 1. PAP 1 in this case here, before the change, PAP 1 was 1,800, which gave these ninjas a what figure? 8,300. So 8,300 immediately here, these guys went ahead and they sold. Now they sold 20%. They sold 20%. So immediately they sold this 20%. What was their new value? Their new value was what here? 4150. They sold. So before the change, immediately before the change, their value was 8,300. 8,300. And then they sold 20%. So their value reduced from this to 4150. So in this case here, that entire value is a benefit for the parent. Is a benefit for the parent. So in this case here, that will be taken as revenue or as benefit, or as benefit, which will be 4150. At what cost? The cost is 3,000, which gives us 1150. Now, ladies and gentlemen, do we have any other thing really? Look at non-current liabilities. Are you able to see the 10% loan notes? Is there somebody? I mean, there's no adjustment there. So for the loan notes, take 10,500 plus 3,500. The answer is 14,000. For the 10% under non-current liabilities, We have there 10,500 plus 3,500. So we have 10,500 plus 3,500 giving us 14,000. Then we have the deferred tax there. So the deferred tax, we are taking the one of the parent. The one of the parent is how much a deferred tax. The one of the parent is 6150. 6150 plus 1870 actually, plus 1870. Is there somebody who is able to give me the deferred tax figure? Anybody who is able to give me the deferred tax figure? 8020, isn't it? Deferred tax figure is 8020, 8020. Then from there, ladies and gentlemen, you go straight away to the current liabilities. So under current liabilities, what do we have there? So under current liabilities, what I can see there is trade payables. So we have the payables. We have the payables. Payables of what here? 5,700. 5,700 plus 3,100. Which will give us what figure? Which will give us what figure? 8,800, yes. 8,800. 8,800. And then the last one here is current tax. So the last one is the current tax, where tax I'll take 1645 plus 1645 plus 735 plus 735, which will end up giving us what figure? Somebody 1645 plus 735, 2380, 2380. So can you kindly take a bold step and go ahead and give me the total equity and liabilities? You add from all the equities that you have, and all the liabilities. I don't have to say like, this is a total and current asset, total no. At fine let's go to just column here, all equities and all liabilities, you add up everything, and then you tell me where the question is balancing. Compare the figure that you get with the total assets that you got up there. Compare, and then you tell us whether the question is balancing. I can see Sharon saying it is balancing. It is balancing at 82, 300, and 70. Move aside. It is balancing. Yeah, balanced. Great. Great ninja. Great. Great ninja. Great. Great. Yeah, balanced. Great. But remember, to balance comes at a very, very high cost. Look at the time you have taken to do this question. Look at the time you have taken to do the question. It's 2 hours. If you told me, Mwalimu, do it without caring about balancing, just give us what we call the low-hanging marks, I would have given you those 7 ticks within 40 minutes. Within 40 minutes. And that's what I would want you to be doing. Like this working of retained earnings, don't do it in an exam. If you do it, it will be wrong. You'll get ulcers in an exam. Don't do it. Don't do it. So I'll be able to share with you a marking scheme for you to see how these questions are marked, for you to be able also to come up with your own approach of doing these things. Because AFR is not about perfectionism, no. It's about having as many entries as possible which are correct. Otherwise, thank you very much. So tomorrow morning, I'll be straight away coming to do what we call foreign subsidiary. And it's my hope that everybody will have gone through 1 or 2 videos that I sent. So when I come tomorrow, I'm only doing 1 question. And then I do 2 questions on group cash flows. It's a separate topic, remember. So the 2 questions will be, one will be the direct method, indirect method. And then, that topic will be it. So then we start now doing the other smaller topics very fast. We'll say bye-bye as you guys march towards casting. So thank you so much. See you tomorrow at exactly 5 a.m. Bye. Okay. I don't know what Jane is writing there. Jane, I don't understand. I don't understand your figure. Yeah. That will be very good. Oh, the baby typing. Great. That is the essence of what here online classes. The babies are good. As our deputy president tells us, let's get as many as possible. Thank you and bye.